The first step I suggest taking is to understand what property or what asset you're reviewing, because the financial statements can look different for multifamily, which is apartments, or perhaps senior living, depending on how the senior living is classified. But understand if you're looking at multifamily or office or retail, because those financial statements can be presented a little bit differently. They can have different accounts on them. They can have different types of activity that goes on. Different revenue streams, different expenses. So if you can understand, first of all, the type of property that you're looking at, then that will set a very good context for the financial statements that you're reviewing. And then from there, just to understand, again, what type of property you're looking at, and then what's going on at the property, because your financial statement should reflect that. Your financial statement should reflect, obviously, all the assets that you have on hand, your cash, any receivables that you have. But on a lot of these financial statements, if your receivables are too high, then you have to ask why, because you're not in the business of loaning money to your tenants. So why would you have a large receivable balance? Again, understanding what's going on with the property, what's typical for a property, what type of liabilities you have, what's going on with that. Even understanding where you are in the year. So at a certain point in the year, you may have on your balance sheet, for example, a large accrued real estate tax balance, or at certain points of the year, it might be zero. So just understand, well, they just paid the real estate taxes, or they have not paid them yet. Different things like that to understand what's going on the balance sheet side.